Hello, very good morning to all, and welcome back to today's daily dose of market insights. Very good morning. I'm Kelvin. Today will be Thursday, the 26th of June 2025. So, as usual, before we jump straight into today's gist of the daily dose of market insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, before we jump straight into the intraday technical outlook on the broad-based cross asset classes that we cover on the daily basis, that means i.e. the major US dollar pair, the major stock indices, and as well as West Texas crude oil and West Texas crude oil, which is WTI, and gold XAU/USD. Let's have a quick review and recap what has taken shape yesterday in terms of news flow, economic data releases, and as well as this this particular impact data and releases impact on the various intraday movement of the respective broad-based cross asset classes. So let's start with the US movement of the US major stock indices yesterday. So yesterday was rather a lukewarm session in the major US stock indices. So it opened strong, but throughout the entire US session yesterday, the major US stock indices tended towards the close, right? So the SPX closed yesterday, US session almost unchanged. The Nasdaq 100 was the top performer, managed to inch out a gain of 0.21%. So if you look at the Nasdaq 100, on an intraday basis, it managed to print a fresh all-time high at this 22,338 level. Right, let me share with you. Okay, why is it not moving? Okay, strange. Okay, give me a minute. Never mind. Okay, good. This is the Nasdaq 100. So you can see that the Nasdaq 100, yes, it print 22,330. So that's actually a fresh all-time high on the Nasdaq 100 upon the first opening hour at 21:44. All right, so that's probably about 15 minutes after 9:30 p.m. Singapore time, where it's the first hour of the US session starts. Pop up fresh print fresh all-time high above 22,250 that was printed earlier this year. But however, the upside momentum could not maintain, and the Nasdaq 100 thundered off or sold off throughout the I would say not really sold off, remains kind of rather lackluster due to profit taking opportunities or activities that lasted the entire US session, but still managed to inch out a gain of 0.21%, but it closed near the session low, which is from an intraday perspective, is not positive at all. So still recall that yesterday on a very short-term intraday technical outlook on the three major stock indices that we cover on a daily basis, the SPX, the Nasdaq, and as well as the US Wall Street 30, which is representing the Dow Jones Industrial Average. We do have a bearish bias for a short-term pullback, and the short-term pullback indeed takes shape on the SPX, the Dow Jones, the Nasdaq 100. Yes, it tested the pivotal resistance at around 22,250, but can't maintain that momentum and dwindled downwards. So later I'll cover for you guys again the short-term intraday technical outlook on these three major stock indices that we do on the daily basis, where I am having where I am expecting that it will go for today. All right, based from a technical perspective, but we know that the intraday price movement on the SPX and the Nasdaq 100 doesn't look that great by looking at the intraday move. All right, so now going back, if you look at the Dow Jones, was the one of the worst performer. All right, so the Dow Jones closed negative 0.25%, and the worst hit was the Russell 2000 over here, down by negative 1.16%, and it closed near at right exactly at the session low on the last hour of the US trading session yesterday. All right, so what you could see over here is a rather lackluster movement of the major US stock indices. So why the Nasdaq 100 managed to held out that well is because of the mega cap stock that has a higher significant weightage on the Nasdaq 100 versus the other rest of the other three indices. Most of them managed to close in the green, with the exception of Amazon, Tesla, and Meta. Okay, so Tesla was the worst performer, down negative 3.8%, followed by Amazon down negative 0.37%, and Meta down by negative 0.5%. And the remaining four closed in the green, with the top performer Nvidia positive 4.33%, and it hit a fresh all-time closing high yesterday. So Microsoft 0.44%, then Apple 0.63%, and Google Google Alphabet positive 2.3% over here. And the one of the reason that actually explained this lackluster movement in the major US stock indices was because of not much news flow that is coming up from the Middle East. Because do not forget, over here is that the rally that's kickstart in the last 2 weeks since Monday and Tuesday is primarily driven by the reduction in the geopolitical risk premium arising from the Israel-Iran conflict that kickstarted since 13th of June. And since the start of this week, US President Trump proclaimed that he has brokered a ceasefire deal, and this ceasefire deal has been cemented. And yesterday, Trump actually made a remark again, stating that US and Iran will talk next week, and the Middle East war is over for now. So that has really been priced into the major US stock indices since the movement of Monday and Tuesday. So this is not a new news. I would say. So it's more like right now, profit taking activity start to set in the major US stock indices, awaiting for fresh new catalysts that could potentially boost the stock market higher. So potential fresh catalysts right now was centered on the looming 90-day grace period, which is about to end soon, on higher US reciprocal tariff that Trump announced in April during his Liberation Day speech, and that will the deadline will be on the 9th of July. And now it's about 2 more weeks. So in these 2 more weeks, market participants will start to see whether would there be any negotiation breakthrough between EU and US, Japan and US, and as well as India and US, and any particular news flow surrounding China and US, whether the earlier breakthrough talk where China now is allowed rare earths to flow through US, are they abiding to this agreement? So these are the possible catalysts that could actually trigger off the next significant movement in the major US stock indices. So for now, rather muted performance. And also wanting to highlight why yesterday US stock indices was rather muted, because we have a global growth barometer, which is FedEx. All right, so FedEx, you know, that is one of the biggest global international, we call it a shipment company, not shipment, delivery company that develop parcels internationally. So their profit guidance and their profit performance reflect the prospect of global growth. So think about it. If global growth starts to slow down, nobody will wants to actually ship goods here and there. All right, so they are actually like a middleman for, it's like a delivery middleman. So yesterday, FedEx warned of pain ahead with tariffs weighing down on external demand. All right, so FedEx warns that its profit will be worse than expected this quarter, and they declines to offer guidance for the rest of the year due to uncertain demand environment. And the company share price fell 5.6% after reporting its quarterly results. All right, with Q1. So net overall, given that this is a barometer of FedEx being a barometer of global growth, given its rather lackluster guidance, and also referring to offer guidance for the rest of the year, that actually also sip out the bullish momentum that was seen in the major US stock indices on the last 2 sessions, which is Monday and Tuesday. Right. So yesterday, Fed Chair Powell do his last testimony, the second last testimony. So when Fed Chair Powell testified in Congress, it will be 2 days. The first day, which has already concluded on Tuesday, he will testify to the House Finance Committee, and the last day, which was yesterday, he will testify with the Senate Finance Committee of. Okay, so in yesterday's testimony is still no major changes as compared to the first day. He also mentioned that tariff-driven inflation remains a big question. So Powell said that the U.S. Central Bank is still struggling to determine the impact of the consumer prices. So yesterday he testified before the Senate Banking Committee, citing that strong economy and uncertainty over how the tariffs will affect inflation, repeating his message that Fed officials need not rush to lower rates. So that is no major changes. So that in fact doesn't really change the doubt of the Fed funds market expectation right now based on the CME Fed Watch 2. So based on the CME Fed Watch 2, markets still expecting the Fed to stamp pat in July, despite that some of the members, two of the members, Federal Reserve officials, Bowman and Waller, giving hints that they will be in favor of cutting in July. All right, but so net overall, what we could see is that on the Fed funds futures market, as compiled by the CME Fed Watch 2, over in July, still rather high chance, 76%, despite that has been reduced last week from 87%. All right, still a high chance of 76% that the Fed will remain stamp at 4.25% and 4.5% on the next FOMC meeting, which is 30th of July. And if you look down the calendar, the higher probability of the first interest rate cut in 2025 is likely to come in the September meeting, not 17th of September, with a high chance of 87% to bring it down lower by 25 basis points to 4% to 4.25%. And potentially right now we have a higher odds. Previously, 1 week ago, we was only less than 50% that the Fed will do the second cut in October. But right now we have a rather high odds that the Fed will move the second cut forward to 29th of October, right now at 80%. So that was previously brought forward 1 month earlier, where market previously last week priced in the second cut to come in the 10th of December meeting. Right, so then that overall is just the same magnitude of interest rate cut expected as pricing by the Fed funds futures market. Is only that the second rate cut is being brought forward to 2 months earlier. I would say that to one meeting earlier, from December to October 2029. Okay, 29 October 2025, pardon me. All right, so net overall, this expectation that the Fed may still reduce interest rate this year causes the US dollar to plummet. All right, so the US dollar continues to actually shape its decline as expected. So this is the 5-day rolling performance of the dollar. So the dollar remains weak against the major currency, and based on the 5-day rolling performance, is the weakest against the Swiss franc, the euro dollar, and the sterling dollar. All right, both down by negative. The US is down by negative 1.7% against the Swiss franc, down by negative 1.71% against the euro dollar, and the dollar is down by negative 1.8% against the sterling. And if you look at the 5-day rolling performance of the dollar, that is uh, inching downwards, and that's inching downwards also correspond with the US Treasury yield 2-year spread versus the rest of the world. Okay, that means basically what I do about this light green line here is the US Treasury 2-year minus off the respective 2-year of the various key economies: Germany, UK, Japan, Canada, Swiss, AU, Australia, and China. So it's a simple weighted average of this 2-year spread of this other major currency. So it's basically just take it as a fact that this is a spread of the 2-year US Treasury yield minus the 2 years sovereign spread against the rest of the world. Right. So basically the yield premium of holding US Treasury yield, the shorter term tenure 2-year, is getting lesser versus the rest of the world. So that also kind of support the ongoing dollar weakness as well, at least in the short term. And bear in mind, like I explained yesterday, the dollar index now is actually trading very close to a key support level. So what we could see is that since 23rd of July, after that bearish 23rd of June, pardon me, which was this Monday, after that bearish reaction of the 50-day and the 20-day moving average, it continues to trade for 4 consecutive daily closes, lower closes, and right now is testing the key critical support of 97.4 on the US dollar index. So why this 97.4 very important? If we go to the monthly chart over here, right? So this 97.4 is in fact right now the lower limit of this long-term circular ascending channel that has been in place since May 2011 low. All right, so if we could have a bearish breakdown below 97.40 and a weekly close below it, that actually potentially kickstart or reinforce a major downtrend phase for the US dollar by using the US dollar index as a gauge. That means, i.e., we could be on the brink for multi-month weakness of the dollar if this 97.4 critical level on the US dollar index is broken down and have a weekly close this week. All right, and with that, the yesterday the sterling, the dollar, the euro dollar, that means the sterling actually hit a fresh multi-year high against the dollar. That was, I think, about February 2020 2022 high. And for the euro dollar, it also hit fresh all-time multi-year high as well. So that's the highest level since October 2021 on the euro dollar. So later I'll touch on the euro dollar and the sterling dollar short-term intraday technical chart over here, which has been moving on nicely within our expectation so far in the last 2 weeks or so. All right, so oil price. So oil price yesterday managed to actually stabilize. So if you look at WTI crude, yesterday it managed to actually inch out some a slight a reduction of the previous 2 days of dramatic decline of negative 15%. So yesterday, WTI crude closed down slightly lower, negative 0.18%. And after that, you take a look at it starts to form this kind of doji candlestick with a small little body. So it appears that right now, WTI crude oil is start to do a bit of consolidation after that dramatic 2 days of bearish reversal on due to the onset of this breakthrough where US President Trump managed to broker a ceasefire deal between Israel and Iran, ending this 12th day of war. And one of the reasons why oil prices, WTI crude oil price managed to consolidate and didn't fall further yesterday is because of the weekly US EIA crude oil stockpile change that came in that has a much more dramatic drawdown as expected. So it's a reduction of oil supply in the US over here. So basically what I could see is that market initially only expecting a drawdown of negative 0.75 million barrels of oil in the US, but however, it drew down much deeper in the rate of negative 5.836 million negative 5.884 million barrels of oil. So given that is a larger drawdown of the US EIA crude oil stockpile statistics, so a reduction of supply, so that also lead to a consolidation of the WTI crude oil prices yesterday, negating the last 2 days of Monday and Tuesday dramatic bearish reversal sell off of negative 15%. And with that, gold price also holds steady around the 3,300 level as well. So gold price XAU/USD managed to hold steady also due to the indirect, we call it a positive indirect impact on a weaker dollar that we see yesterday. All right, so with that, let me now touch on the second segment of today's daily dose of market insights, which is the intraday technical outlook. All right, so with that, let me expand my screen. Okay, so now let us start with the FX market, starting with the euro dollar. Right, so the euro dollar appears up as expected right now. So in today's Asia session, it continues its momentum, up by 0.36% right now as we are speaking, and almost hit our resistance level at 1.725/1750, which is also the upper limit of this medium-term ascending channel, linking the lows since 13th of May 2025, and as well as a cluster of Fibo extension level, or centering at 1725, 1.1750. And given that the RSI is at the overbought level, but there is no sign of a bearish divergence at this juncture, so I do not see a dramatic corrective decline move in today's session, but rather a minor pullback to actually take into account of this current intraday overbought condition that is being displayed on the hourly RSI. So overbought level, support level to overbought support level to watch in the first step will be at 11660, maximum 11625. So 11625 will be my pivotal support level. So for today's view, I will be more looking for a pullback. Then after this pullback, potentially we may start to see the continuation of the bullish uptrend move on the euro dollar. So i.e. still maintaining my intraday trend bearish bias after this potential pullback end, using a tightened short-term pivotal support at 11625. Above 11725 slash 1750, may see the next resistance coming in at 11780, which is the one-time Fibo extension of the minor swing low of 23rd of June over here, and 11780. If you go to the 4-hour time frame, also graphically is also this swing high area here in the past. That's 2021 area. So this is the congestion area over here, the minor congestion area of 13th of September 2021, previously got rejected on 17th of September 2021. So this is the minor congestion area over here. So that is the bias that we have on the euro dollar for today. I repeat again, potentially minor pullback. After this minor pullback, we'll be still maintaining our trend bullish bias, given that there's no bearish exhaustion there's no exhaustion signal that is being flashed out on the hourly RSI, and based on the elliott wave perspective, is now trading in this minor impulsive wave 3 with the minimum target at 11780. So but however, if price action starts to break down and have an hourly close below 11625, this intraday bullish bias view will be invalidated for today to kickstart a much more pronounced minor corrective decline sequence again, exposing 11580. Then thereafter seeing the next key short-term support at 11550 before a bullish reversal starts to take shape. Why? Because the price action is still trading above the 20-day moving average. So that's for the euro dollar. Next up will be the sterling dollar. So the sterling dollar also broke above the 137 figure level, now approaching our next resistance at 137.50 level over here. Also a very strong impulsive up move sequence as well. And what we could see is that the hourly RSI continues to be hit the overbought level, all right, over here, but no signs of exhaustion because there's no bearish divergence no bearish divergence that has been taken shape so far. So what you could see over here is that potentially there could be a minor pullback taking shape to work out this overbought condition that is being flashed out on the hourly RSI. So I will tighten my short-term pivotal support level today to a zone at 136.30, 135.70. Okay, so this area here, okay, this zone here, so very clearly this is previously a kind of a minor range top, now turns into a critical short-term intraday pullback support area. So that will be the 136.30, yeah, 1.3630. Okay, 135.70. And also based on the elliott wave perspective right now, we are now in the midst of undergoing a impulsive wave 3 minor wave 3 sequence, this being wave 1, wave 2, and wave 3. So this wave 3 still has some more room to run for the minimum target of 1.3870. So for on the intraday basis for today, two resistance to level to watch: 137.50 followed by 138 figure level, 138.30, which is the 0.764 Fibo extension taken from the low of 23rd of June. So only a breakdown below 135.70 that will invalidate today's intraday trend bullish bias to see a deeper minor corrective pullback towards the 20-day moving average again at 135.30. So once it come back to 135.30, if 135.70 is being given up, I'll be looking up signs for a bullish reversal candlestick to actually flip back to a bullish bias again, given the fact that the short-term uptrend phase still remains intact, and it managed to actually pierce above the 20-day moving average pretty strongly on 24th of June. All right, so that's for the sterling dollar using a tightened short-term pivotal support for today. And bear in mind, there could be a risk of a minor pullback forming during the start of the European session to work out this current overbought condition that's being seen on the hourly RSI, with a tightened short-term pivotal support zone for today to maintain my bullish bias. That will be 136.30 / 135.70. All right, next up will be the Aussie dollar. So like I explained, the Aussie dollar right now is shaping that imminent bullish reversal, a bullish breakout condition, which came in within our expectation as it hit uh, the range resistance level again. So let me share with you this the hourly chart of the not the this is the daily chart of the Aussie dollar. So the daily chart of the Aussie dollar, what we could see that since 24th of April, it has been trading in the complex sideways range configuration with the range top at 65.30 that has been providing resistance since 26th of May. And after that bullish hammer candlestick on the retest of the lower limit of this sideways range, which is also the 20-day and the 200-day moving average, price action reacted very strongly in the last 3 days. And if you look at the hourly RSI, has already giving us a pre-bullish breakout signal over here by linking. Okay, give me sorry, by linking exactly parallel the range top over here on 7th of May, and you link the series of former lower high on the RSI, and right now is attempting to shape that bullish breakout as well. All right, it's inching up higher to test this level. All right, so given a bit of a pre-bullish signal that this imminent bullish breakout of that close to that what three two so is this was late to close to about this 1.5 month of range configuration, that the Aussie dollar may now starts to shape that bullish breakout view. All right, so with that over here, two key support level to watch out for today, right? Given that the hourly RSI now is at the overbought level, so there could be a pullback in first after at the start of the European session to do a bit of consolidation before breaking out potentially. So pullback support. Okay, wait. Pullback support level to watch in the start of the European session potentially to work out this current overbought condition that's being seen on the hourly RSI will be at 165.10. No change in my short-term pivotal support that I have for yesterday. That will be at 64.80. So unless thereafter we start to see a bullish breakout above 65.45, then there I could tighten my short-term pivotal support to 65.10. So for now still remains the same at 64.80. So now looking for chance to actually still maintain a bullish bias on any chance of a minor pullback. Above 65.45 exposes the next two intermediate resistance at 65.65, followed by the psychological level next at 66 figure level. There is also the 11th of November 2024 swing high, and also correspond to the 0.764 Fibo extension taken from the minor swing low of 23rd of June. Only a sudden bearish breakdown and hourly close below 64.80 that would invalidate our intraday bullish bias view to see it wander downwards towards the lower limit of that complex sideways range again at 64.55 / 64.44 level, and below it may see 64.07 next. So i.e. in a nutshell, potentially the Aussie dollar may now start finally see a immediate bullish breakout from this 1.5 months of range configuration. But support level still remains unchanged given the fact that the hourly RSI is at the overbought level. So there could be a risk of a minor pullback taking shape. first before that bullish breakout occurs. So that's for the Aussie dollar. Next up will be the dollar yen. So the dollar yen managed to push down as expected as well, revisiting that first support level at 144.50. A bit of yesterday we do have a tighten short-term pivotal resistance level. So I do mention that if this resistance level gives way, the next resistance level to watch will be 145.25. So this 145.25 didn't have a positive breakthrough above it, and price action shaped that vicious inverted V-shaped bearish reversal and goes back down below 145.20 again. So with that, we now starts to see the bullish momentum coming back into the picture after this inverted V-shaped bearish reversal that has taken shape right below the 145.25 level. So for sure, using 145.25 level, that will be my short-term pivotal resistance level, maintaining our intraday bearish bias within this complex range configuration of the dollar yen that has taken shape since 27th of May 2025 low. Support level to watch 145.50, a breakdown below it exposes 143.90, followed by 143 figure level, which is the range minus which is the range bottom, all right, at 143. Only a bullish breakout and the hourly close above 145.25 that will see a squeeze up towards the upper limit of the range, with the resistance coming in at 147.15, followed by 148.60, which is the minor swing high of 13th of May. So that's for the dollar yen, using 145.25 as my short-term pivotal resistance level, maintaining our bearish bias within this complex range configuration that is still evolving since the low of 27th of May. So that's for dollar yen, and also sum up the intraday technical outlook on the major dollar pair. So now next up will be the major stock indices, starting with the Hong Kong 33. So the Hong Kong 33 hit our first resistance as expected, did that minor pullback, and in today's Asia session tested our support level at 24,240 before staging a minor bounce as we are speaking right now. So since it didn't break above 24,490, I do not want to tighten my short-term pivotal support level to be so tight at 24,240. So still maintaining it at 23,880 as my short-term pivotal support level, maintaining this ongoing bullish impulsive up move sequence that has kickstarted since the low of 20th of June within this minor ascending channel that is still in shape since the low of 2nd of June. Next resistance level to watch above 24,490 will be at 24,850, which is the medium term swing high area of 18th of March and 19th of March over here. Only a bearish breakdown below 23,880 will see a deeper minor corrective pullback towards the next support area at 23,690/560. Below it may see the next support coming in at 23,260, which is the lower limit of this minor ascending channel, and as well as the gap up support level that was formed on 20th of June and the minor swing low of 23rd of June. Okay, so that's for the Hong Kong 33, still maintaining our intraday trend bullish bias. Next up, very interesting, will be the Nikkei 225. So still recall yesterday, Nikkei 225, we flipped to a bullish bias because anticipation of that bullish breakout from that symmetrical ascend, also from that ascending triangle range configuration that was previously in place since 13th of May. So it managed to break out from a 4-week range and now rally up to a 4-month high over here. So a very strong bullish breakout itself over here. So with that, the hourly RSI has already also hit the overbought level. So there could be a risk of a minor pullback taking shape right now to work out this overbought condition that is being seen on the hourly RSI. So minor pullback support to watch out for in first step will be 39,145. So we'll be still maintaining our intraday trend bullish bias on the Japan 225, but bearing in mind there could be a pullback taking shape first before the impulsive up move continues. So maximum pullback to look out for will be at 38,850 for sure, which is the pullback support of this symmetrical pullback support of this former ascending triangle range resistance, now at 38,850. So using a tighten short-term pivotal support level towards 38,850. We will still maintain our intraday trend bullish bias after the pullback has taken shape. Next resistance level to watch above 39,560 will be at 39,830, followed by 40,280, which is this congestion area over here of 7th of January and 24th of January this year. Only a breakdown, a bearish breakdown and an hourly close below 38,850 will invalidate this bullish bias view, and also state that yesterday's push up is a failure bullish breakout and price action may dwindle down towards the lower limit of the range again. First support level to watch 38,560, followed by 38,150, 38,035, which is the lower limit of this ascending triangle range support level, and also the confluence with the rising 20, 200 and the 50-day moving average, all confluencing at this zone at 38,150, 38,035. All right, so that's for the Japan 225. Next up will be the Germany 30. So Germany 30, yesterday we expect a pullback take shape. Pullback stopped exactly at my Titan short-term pivotal zone, which is the gap up support, and the former minor swing high of 18th of June and 17th of June, which is at 23,510, 23,440. And what I could see is that the RSI also now has started to shape a higher low right after the bounce off from this key parallel ascending trend line that I draw from the low of 12th of June. All right, so there's a higher low that's being formed, indicating that the momentum, the bullish momentum, may start to sit back into the Germany 30 index over here. So for sure, no change using 23,510, 23,440. That will be still my short-term pivotal support level, maintaining a intraday bullish bias for the Germany 30. But right now we do have a lower resistance level, which was yesterday's minor swing high, and so correspond to the 20-day moving average now, acting as the intermediate resistance at 23,740 level. So that will be my first resistance level to watch for today in my bullish bias view. Above 23,740 may see the next intermediate resistance coming in at 23,880 next. All right, so only a bearish breakdown below 23,440 will see the minor corrective decline extend to the downside to revisit 23,280, which correspond to the rising 50-day moving average. If this 23,280 gives way, then potentially this impulsive up move sequence that has taken shape since 20th of June will be in doubt. That means this movement here may be just only a corrective dead cat bounce, and multi-week bearish trend may resume, exposing the next support level to watch in first step at 22,910, which is the minor swing low of 6th of May. Right, so that's for the Germany 30. And now moving on, next will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 over here, the US Wall Street 30, which represent the Dow Jones Industrial Average, inched down lower as expected below our short-term pivotal resistance that we have at 43,290 level. So with that, we will still have this view at this point in time that there could be still another leg of minor corrective pullback to retrace this rather steep up move that is being seen at the start of this week, which is Monday. All right, so we do the Fibo retracement. There could be some form of retracement back towards the 50% mark level and the 61.8% mark level, which also correspond with the 200-day and the 20-day moving average. All right, so no change, still maintaining our intraday bearish bias for this potential retracement or minor corrective pullback to extend further on the downside back towards the 200-day and the 20-day moving average. So this is something like a mean reversion decline on the minor scale. First support level to watch 42,860. A breakdown below it exposes 42,650 / 42,480. Only a bullish breakout and an hourly close above 43,290 invalidate today's intraday bearish bias view to see the start of another impulsive up move sequence extending upwards towards 43,740, which is the 0.1 time Fibo extension taken from the low of 23rd of May, and graphically is also this minor congestion area of 3rd of March. All right, so that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 also staged a bit of bearish reaction of the 6,126 short-term pivotal resistance level, and continues to print a series of lower high over here. So this bearish divergence still takes shape over here, lower high. So net overall, there also could be some form of a mean reversion decline taking shape to actually retrace some movement of that steep impulsive up move that has taken shape since Monday. So if we do the Fibo retracement from the Monday low all the way up to yesterday high, that is the 38 and the 50% and 61.8% Fibo retracement. These are the areas to watch. So in first step, still maintaining that intraday bearish bias for this potential minor corrective decline or slash mean reversion decline scenario to take shape. First support level to watch 6,070. A breakdown below 6,070 exposes 6,050, 6,030 next. Only a bullish breakout in the hourly close above 6,126 that would invalidate today's intraday bearish bias to see the continuation of the impulsive up move to retest the all-time high area at 6,151. Above it, see 6,175, which is the 0.764 Fibo extension taken from the low of 23rd of May over here. So that's for the SPX 500. Now, next up will be the Nasdaq 100. So far, only the Nasdaq 100 managed to breach intraday all-time high at the 22,340 level. But then after that, it came down over here. And what we could see is that the RSI right now has already broken a parallel ascending trendline support, now testing its pullback resistance over here. So given a bit of excess yesterday at 22,340, so still using this 22,340 as my short-term pivotal resistance level, maintaining that intraday bearish bias for a potential mean reversion decline scenario to retrace this steep up move, impulsive up move that has taken shape from Monday all the way up to yesterday's intraday high. So I'm looking at the 38% and the 50% to the 61.8% Fibo retracement, which correspond exactly at the rising 20-day moving average. So with that, maintaining that bearish bias, first support level to watch 22,065. A breakdown below it exposes 21,990 next. Okay, maximum 21,750, which is the rising 20-day moving average. Only a bullish breakout above 22,340 continues the impulsive up move sequence towards the next intermediate resistance zone at 22,420/22,520, which is the 0.764 Fibo extension taken from the low of 23rd of May. Above 22,520, see it have a steeper up move towards 22,710, which is the 2.618 Fibo extension from the low of 19th of June. All right, so that's for the Nasdaq 100, and also sum up the intraday technical outlook on all the major stock indices. Let us now focus our attention to the commodities asset class, starting from that Gold XAU/USD. So still recall Gold XAU/USD, we flipped back to a bullish bias yesterday at 3,300, pardon me, 3,300, which confluence with the 50-day moving average, almost hit our first resistance level at 3,346, which is also the 20-day moving average. So still no change in terms of the level. First support level to watch out for today will be 3,320 level. All right. Okay, maybe I just put it slightly over here. All right, 3,324. Okay, 3,324, which is the congestion area of the intraday congestion area yesterday. 3,324. 3,300 will still be my short-term pivotal support level because it hasn't broken above our first resistance at 3,346. Unless we have a clear break above 3,346 thereafter in the European session, then I could tighten my pivotal support level to 3,324. So level still remains unchanged. 3,300 short-term pivotal support, maintain that bullish bias for the recovery to take shape. Above 3,346 in first step exposes 3,400, which has been a near-term intermediate resistance for gold since the test of it on 17th of June. Only a bearish breakdown and an hourly close below 3,300 that will invalidate today's bullish bias to see the extension of this multi-week corrective decline scenario extending downwards towards the next near-term support at 3,270, 3,250, which correspond to the medium-term ascending trend line from 31st of December 2024 low. So that's for gold XAU/USD. Next up, lastly, will be the West Texas oil. So the West Texas oil, like I mentioned, price action now has started to consolidate after 2 days of dramatic bearish reversal of negative 15%. So if you look at the hourly RSI, continues to print a series of higher low, indicating that downside momentum has indeed started to slow down. So where it slowed down? It slowed down right above the 50-day moving average that is at 64.05. So I'll be using 64.05 as my short-term pivotal support level, looking out for at least some form of corrective bounce or a mean reversion rebound to take shape to retrace certain portion of that steep sell-off that has taken shape on this Monday. So if we do the Fibo retracement, 23.6% and 38.2%. Okay, these are the two levels to watch, which also confluence with the graphical resistance of 67.67, which is the minor swing high area of 24th of June, and also correspond to the 20-day moving average, acting as the next near-term resistance. Acting as the near-term resistance as well. Above it says 69.15/70.60, which is a very important level, sentimentally, because it's the 200-day moving average and as well as the former major descending resistance from 28th of September 2023 high. So if price action managed to surpass above 70.60 and have a daily close above it, potentially what we could see is that this sell-off that has taken shape on Monday is a negative near jerk reaction, and price action of oil price may continues to hold firmly thereafter if we have a daily close above 70.60 level. So but in the meanwhile, taking things one step at a time. So two key resistance level to watch in our potential mean reversion rebound scenario today will be 67.67, followed by the next intermediate resistance zone at 69.15, 70.60. Only a bearish breakdown below 64.05 that will invalidate our bullish bias for that mean reversion rebound scenario to see the continuation of that bearish move, exposing 62.50 followed by 60.30, which is the minor swing low area of 30th of May. Right, so that sum up the intraday technical outlook for all the broad-based cross asset classes as well. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for today? So key data to look out for today, during the start of the European session, that will be at 2 p.m. Germany Consumer Confidence Index that could potentially influence the euro dollar, the euro crosses, and as well as the Germany 30 CFD index. So that for the month of July, market is expecting a slight improvement only to negative 19.3 from negative 19.9 that was printed in June. Then thereafter, we have one ECB officials speaking, ECB Gondos at 5:45 p.m. and slightly earlier at 4:30 p.m. There's a Bank of England official, Brendan speaking. All right, so at 7 p.m. This one pretty much important because it's the BOE boss, BOE Governor Badley will be speaking at 7 p.m. Singapore time, so that could influence the sterling dollar and as well as the sterling cross rate. So into the US session will be rather quiet. We do have GDP growth rate for Q1, but that will be the finalized amount for finalized figure. So you know that in the last couple of months they'll be releasing a preliminary Q1 GDP growth rate. So the more or less it should be the same after a server revision. So this shouldn't have any impact on market movement. That is 8:30 p.m. the final reading of Q1 US GDP growth rate. Then thereafter it will be a rather quiet US session. Then we have at 9 p.m. Fed hallmark speech. Then thereafter will be nothing much of importance in terms of the US economic data. And also I want to stress that in early Asia session tomorrow, we have key Japanese data that could influence the dollar yen and the yen crosses, as well as the Nikkei 225 will be the leading Tokyo core CPI data that is out at 7:30 a.m. Singapore time, followed by 7:50 a.m. Japan retail sales as well. All right, so that will be tomorrow early Asia session. So with that sum up today's Daily Dose of Market Insights. I'm Kelvin here signing off, and I wish you all a great day ahead, and we shall speak again tomorrow. Thank you.